Gold demand didn't politely react at the open. Someone got cornered by the math, and the market just flashed the receipt in real time, even as the Fed wants everyone to believe nothing changed. That's the conflict right there. The institution needs a stable story, but price discovery at the open doesn't care about the story. It cares about positioning, liquidity, and who has to do what next. And the hidden mechanism most people missed is that the move wasn't driven by a single headline at all. It was driven by a chain reaction between the implied rate path, the dollar impulse, and dealer hedging flows that flip direction when certain strikes and levels get breached. And that's where the real pressure starts. Here's what you saw, even if the tape tried to disguise it. Gold ripped into fresh highs this week, pushed above the psychological numbers that used to sound insane, and then, almost on cue, got hit with a violent air pocket that felt like the floor disappeared for a few minutes. That kind of move doesn't happen because a million people suddenly change their minds at the exact same second. It happens when liquidity thins, stop stack, and the biggest participants get forced to rebalance. Risk right into a narrow doorway. But that's not the part that matters. The part that matters is why it happened now, at the open, right after the Fed meeting, right as the calendar hit a nasty junction. End-of-month positioning, post-FOMC repricing, and an options window that mechanically changes dealer behavior whether anyone wants it to or not. Because if this one window is closing, the math changes. Let's strip it down. But markets don't trade the decision, they trade the path. If traders sense that the Fed is pausing, hesitating, or simply losing confidence in the straight line narrative, the repricing shows up first in expectations, Fed funds futures, rate volatility, and the dollar's immediate reaction. And gold is hypersensitive to that because gold is basically the lie detector test for real yields and confidence. Not in a mystical way, in a mechanical way. If the market thinks the future policy path is easier than previously priced, real rate pressure eases at the margin. The opportunity cost of holding gold drops, and the bid shows up fast. But if the dollar snaps higher for even a day or real yields lurch, gold can get punched in the face even while the larger setup stays intact. That's the paradox that ruins people. And the next detail is what flips the whole setup. When you hear gold trades real yields, most people picture a slow academic relationship. What actually happens during these fast, nasty moves is reflexivity. Positioning meets hedging. Futures and options are the tip of the spear here. This is why you'll see gold look calm for hours and then go feral in minutes. It's not random, it's structure. Now, the hidden detail I want you to lock in is this. The open wasn't just a time of day move, it was a forced flow move, and forced flows don't announce themselves with a press release. They show up in how price behaves around levels and how the market prices time. Watch the curve, watch the spreads, because the spot price can be loud and still be lying. And that's where the real pressure starts. In a normal world, gold's futures curve tends to be in contango. Future prices a bit higher than spot because of carry, financing costs, storage, insurance. That's boring, but it's foundational. When stress shows up, you don't always see it first in spot. You see it in the cost of borrowing metal, in the nearby versus forward spread, in the scramble for the right contract at the right moment. Even if you never look at a curve in your life, here's the translation. When the market gets anxious about immediate availability or immediate hedging needs, near-term pricing can tighten relative to later pricing, and the spreads start screaming. And if spreads scream while headlines say calm, pay attention to spreads. But that's not the part that matters. The part that matters is why the open was the battleground. The open is when the market has to reconcile two realities at once. The narrative everyone repeats and the risk books everyone actually runs. If you're a fund that got long into the rally, you're sitting on massive gains and you're thinking about month end. If you're short, you're thinking about margin and the risk of gaps. If you're a dealer who sold options into the run-up, you're thinking about your hedge ratio, not your opinion. And if you're a real-world buyer, industrial, jewelry, sovereign, you're thinking about whether these levels change your procurement behavior. That's 4 different clocks ticking at once. And at the open, those clocks collide. Now let's talk about the calendar trigger, because this is the why now that most people ignore until it bites them. Late January into early February is often a pressure zone because you get month-end rebalancing, post-central bank meeting repricing, and crucially, options expirations and contract roll behavior that can shift the market's pin level. Here's the simple version. When a lot of options are clustered around key strikes, big round numbers, recent highs, major psychological levels, dealers tend to hedge in a way that dampens moves when the market is pinned and then amplifies moves when the pin breaks or expires. That sounds abstract, but it's not. Imagine a rubber band stretched around a price level. As long as the band is intact, price gets pulled back toward it. When the band snaps, because the options expire or because price jumps through the cluster, the pull becomes a shove And at the open, that shove can be violent, because if this one level breaks, the math changes. Here's the mechanism explainer without the jargon trap. Dealers who sell calls are often short gamma. That means as price rises, they need to buy to stay hedged. As price falls, they need to sell. They're not doing it because they believe in gold. They're doing it because their book demands it. In a calm tape, this can look like smooth liquidity. In a fast tape, it becomes gasoline. So if gold is ripping toward a round number and call activity is heavy there, the hedging can help push it further until it doesn't. Then if price reverses, that same hedging flow flips and accelerates the drop. That's the trapdoor. And when you combine that with a market that just got a Fed signal shift, again, not a cut, a shift, you get exactly the kind of open where gold demand looks like a sudden stampede. But it's not only emotion. This move isn't emotion, it's math. And that's where the real pressure starts. Now let's stack proof, because this can't be a single argument story. First proof point, the price context itself. We just watched gold surge through major psychological thresholds this week, printing fresh records near the mid 5,000s per ounce, and then we saw a sharp reversal that knocked it back toward the low 5,000s. It doesn't tell you the trend is dead. It tells you the market is crowded and the crowd is sitting on leverage somewhere. Second proof point, the Fed. The central bank held rates around the mid 3% area and paused after prior cuts, while emphasizing inflation still above target. Whether you think that's hawkish or dovish isn't the point. The point is that when a central bank pauses in a market that is hypersensitive to the path, traders start gaming the next step, not the current step. That increases rate volatility. Rate volatility spills into FX. FX spills into gold. Third proof point, the calendar. Right after that meeting, we're staring at month-end behavior. Funds that run mandates don't care about your narrative. They care about exposure and risk budgets. If gold rallied hard into month-end, some managers mechanically rebalance, sell a bit of what's up, buy a bit of what's down, to keep weights in line. That creates predictable cross currents. And at the same time, short-term derivatives positioning gets reset around expirations. That's a recipe for open volatility. Fourth proof point, on-the-ground symptoms. Reports out of Asia described customers crowding into gold shops in places like Shanghai and Hong Kong during the run-up, which matters because it's the real-world feedback loop. Rising price can actually increase demand when the demand is driven by fear, currency stress, or a store of value impulse. That's reflexivity in the physical world. Fifth proof point, institutional behavior beyond central banks. There's been talk of big pools of capital diversifying into physical gold allocations, not because they suddenly became romantics, but because they see gold as neutral collateral in a world where policy feels unpredictable. Whether it's funds, corporates, or crypto-adjacent treasuries adding gold, the important part is the same. It broadens the buyer base and changes how dips get treated. Sixth proof point, market structure signals you can actually track even as a retail investor. Watch how gold behaves around round numbers like $5,000, $5,200, $5,500, and the recent peak zone near $5,600. Those aren't magical numbers. They're behavior lines. They're where stop orders cluster, where option strikes accumulate, and where risk managers force adjustments. If gold can reclaim and hold above a behavior line after a violent flush, that's a trend signal. If it can't, that's not the end, but it changes the near-term playbook. But that's not the part that matters. The part that matters is how you keep your brain from getting used against you during the chop. Because volatility is the weapon here, and the next detail is what flips the whole setup. Most people think manipulation looks like a villain twirling a mustache. In real markets, the manipulation is often just incentives plus structure. Liquidity is thin at certain times. Stops sit in obvious places. Headlines hit when they hit. Funds have rules. Dealers hedge mechanically. None of that requires a conspiracy. And all of it can produce price action that feels personal, like the market is hunting you. That's why I'm going to give you a viewer psychology shield right now, and if you internalize nothing else, internalize this: price can whip around violently even if the thesis is correct. Your job is to separate trend signal from noise. Noise is the intraday wick that exists to force decisions. Signal is what price does after the wick. Does it reclaim levels? Does it compress? Does it trend? Does it hold into closes? And the open is the noisiest place to make emotional decisions because it's where forced flows collide with fresh liquidity. So the shield is simple. Predefine levels, predefine scenarios, and refuse to let a 5-minute candle rewrite your entire worldview. Because if this one level breaks, the math changes, but you want to decide what that level is before the market tries to decide it for you. Now, let's get brutally practical and talk about what comes next, because your audience doesn't want philosophy, they want a roadmap. The next week or two is about whether this move was a blow-off that needs digestion or a regime shift that's still pulling new buyers in. You don't need to guess. You can watch the footprints. Scenario 1 is the controlled pullback and retest. In that scenario, gold chops lower or sideways, shakes out late leverage, maybe retests a key support zone. Think around the low $5,000 with a big psychological focus near $5,000 itself, and then starts to base. The confirmation is that dips get bought quickly, price holds above the behavior line on daily closes, and rallies start to look less vertical and more stair-stepped. In that world, the trend survives, and the next attempt toward the highs becomes more credible because it's built on a base, not on adrenaline. Scenario 2 is the continuation squeeze. In that scenario, the market refuses to give you a comfortable dip. The confirmation there is clean, aggressive reclaim of $5,500, tight pullbacks that don't break prior intraday lows, and an obvious sense that sellers are being overwhelmed rather than negotiated with. And if that happens, the reflexivity machine turns back on, because shorts have to cover into strength, and dealers may have to buy into rising price depending on where the options positioning sits now that the calendar has rolled. But that's not the part that matters. The part that matters is your invalidation line, because credibility lives there. If you refuse to define what would change your mind, you're not analyzing, you're cheering. So here's a clean invalidation framework you can use without pretending to have a crystal ball. If gold loses the $5,000 behavior line and then fails to reclaim it on daily closes, meaning it breaks, bounces, and gets rejected, then the near-term squeeze narrative weakens, and you should expect deeper digestion, wider ranges, and more time required to rebuild a base. It means the market is telling you it needs more time and forced flows are no longer pushing in your favor. And that's where the real pressure starts. Now let's talk about the metric you can watch that's embarrassingly underused. Not just spot price, but the behavior of time, how the market prices immediate versus future delivery, and how volatility is priced. You don't need to be a pro to do this. If you see spot ripping while the curve and spreads look calm, that can be momentum. If you see spreads tighten and volatility stay bid even after a dip, that's often a sign the market is still nervous, still positioned, still capable of sudden moves. Another tell is whether dips in gold are accompanied by strength in the dollar and real yields. If the dollar rips and gold holds anyway, that's a statement. If the dollar softens and gold still can't lift, that's also a statement. Markets speak in relationships, and relationships change before narratives do. But that's not the part that matters. The part that matters is what the move forces participants to do next week. If you're a fund that missed the rally, you're now staring at a chart that changed your risk committee conversation. That often means buying protection, which can keep implied volatility elevated. And that often means covering into liquidity windows, like the open, especially after the market just proved it can gap. That's a real question, because when the big options window shifts, the market's pin can shift with it. And that's how you get a tape that feels like it has a mind of its own. Now, I'm going to give you the next week checklist, because this is where you turn chaos into process. 1. Watch the $5,000 behavior line. Not because it's sacred, but because it's where psychology, option strikes, and risk rules collide. 2. Watch the $5,200 area as a practical battlefield zone. If price stabilizes above it after dips, it tells you buyers are stepping in before panic becomes trend reversal. 3. Watch $5,500 and the prior peak zone near $5,600 as the truth test. If price presses and fails repeatedly, the market may need more digestion. If it breaks and holds, you're in continuation territory. 4. Watch the open behavior specifically. Are opens being bought or sold? Are gaps filling or extending? That tells you whether the market is in hunt stops mode or chase momentum mode. 5. Watch the rate path narrative through markets, not through commentators. If futures markets start uppricing easier policy sooner, that tends to support gold at the margin. If the market swings back toward tighter for longer, gold can get whipsawed even if longer-term demand remains strong. 6. Watch evidence of real demand versus paper churn. ETF flows, physical premiums, anecdotal scarcity, and how quickly price rebounds after flushes. You don't need perfect data. You need consistent signals. Because if this one level breaks, the math changes. Could be. Overbought is real, and parabolic moves often mean pullbacks. But overbought is not a thesis, it's a condition. A condition can persist far longer than skeptics can stay solvent, and it can also reverse faster than believers can emotionally process. The right way to handle it is not to deny it, it's to integrate it. That's why we use scenarios. In scenario 1, overbought bleeds off through time, chop, retest, base. In scenario 2, overbought resets through pain, fast flushes that scare people out, and then snap higher again. If you're emotionally anchored to a single path, the market will teach you humility. If you're anchored to a process, you can stay rational while others get played. And here's the viewer psychology shield one more time, because it's everything. The market will try to manipulate you with volatility. It will show you a flush and make you believe the story is over. Then it will rip and make you believe you missed your only chance. Then it will chop and make you believe nothing matters. That cycle exists to extract bad decisions. Your defense is to define your levels, define your scenario confirmations, and accept that you do not need to catch every dollar of a move to be right. You need to avoid getting wrecked by the parts of the move that are designed to wreck you. That's not fear, that's risk management. And yes, this is not a promise of returns, and it's not a guarantee of direction. It's a map for how to think when the tape is trying to make you stop thinking, because that's where the real pressure starts. Now I'll close with the concrete payoff I promised, targets and validation, and the next week checklist in one clean bundle. Upside target, zone 1, is a reclaim and hold above $5,500 because that's the behavioral you can't unsee it line. Upside target, zone 2, is the prior peak area near $5,600. If that breaks and holds on daily closes, the market is signaling continuation, and you should expect elevated gap risk around opens and thinner liquidity during off hours. Downside support zone 1 is the low 5,000s, where the market has recently found its footing after the flush. Downside support zone 2 is the $5,000 behavior line itself. Invalidation for the near-term squeeze narrative is sustained failure to reclaim $5,000 after losing it, break, bounce, reject, because that shifts you into a longer digestion regime where the next move could be sideways or lower before any new highs. And the next week checklist is simple. Watch how price behaves at the open. Watch whether dips get bought quickly or sold into. Watch whether the market can build higher lows above $5,200. Watch whether $4,500 becomes a ceiling or a floor. And watch whether the macro impulse, rates and the dollar, supports or fights the move. If those boxes line up, you're not guessing, you're observing. And if they don't, you're not betrayed, you're simply updating your map. That's the whole game. And if you're the kind of person who wants mechanics, not vibes, who'd rather be early and wrong with a clear invalidation than late and confident with no plan, then you're already in the right crowd. Stay sharp this week. The open is where the market will try to steal your attention. Don't give it your discipline.